The bears make money, the bulls make money, the hogs get slaughtered. What this means is greed is a trading enemy. One of the enemies of a trader is greed. A greedy trader is impulsive. A greedy trader revenge trades. A greedy trader is always lacking in discipline. A greedy trader is never satisfied with what the market can give. A greedy trader wants more than the market can give. In an ever-changing environment, the need for structure is indispensable. So that is why we are here today with our tutor on how to build a structure in an ever-changing environment. The ever-changing nature of the market allows for limitless opportunities to arise, and these opportunities, if well seized, yields unimaginable profits. In a market where a rich man could get poor and a poor man could get rich, the market does not care about who you are as a trader or where you are from, as this market reduces all traders down to numbers. It is a market without emotion. It is a market driven solely by logic. All these candles you see on the chart are perfectly engineered for various purposes. Which purpose? The purpose of the market maker, the purpose of generating profit for themselves. So to be successful in the market, you need to emulate the market maker. You need to emulate the institutional traders, think like them, act like them, and become them. So now, developing a trading strategy is a prerequisite to being a consistently profitable trader. So here we are going to learn how to develop a profitable trading system in this dynamic, ever-changing environment. Having a trading system that is designed, it allows for rationality and stability regardless of market conditions. So now, a fundamental question comes to mind. What is the best trading strategy? There are various trading strategies, there works, and in my opinion, the best trading strategy is the trading strategy that a trader understands best. So to begin with, there are important factors that we keep in mind in developing a trading strategy. The first is the time frame to be traded. So if you are an individual that has a tight schedule, I advise you are a swing trader or a position trader, so you can tune in to the 4-hour or daily charts, as this allows for flexibility to manage your time effectively. If you are a fast-paced trader, you can be a day trader tuning into the 1 hour, and if you are a scalper, you can tune in your strategy, fine-tune it with the 15 minutes. However, for me, my specialty is swing trading, and for the sake of clarity, our example is going to be based on a swing trading methodology we are all going to design here and test. After putting into consideration the time frame to be traded, the second step is to choose your product, as there are various products in the financial market. We have the stocks, we have the commodities, we have cryptocurrencies, we have CFDs, and so on. So you choose your product, whichever product you are comfortable with, and you need to stick to them. Be faithful to your strategy, know your strategy, understand its strengths and weaknesses. Another very important factor to consider again will be the risk to reward. A fixed risk to reward eliminates greed and eliminates fear, and that would be part of the exit strategy. Another factor to consider is defining our risk. Ideally, the risk management threshold is from 1 to 3%. So if you are a conservative trader, I advise you stick to 1% or less. If you are an aggressive trader who has a high appetite for risk and knows how to behave well under pressure, then I advise you stick to 2%. However, if you are a very seasoned trader who is aggressive, then you can go above 2%, not exceeding the 3% threshold. After that, another factor to consider is how your strategy identifies the trend or range. Most strategies perform well in a trending market. However, the best strategies perform in both ranging and trending markets. Another factor to consider will be our entries, which will be determined by the strategy. And another factor to consider will be our exit, which is the stop loss placement as well as the take profit placement. And lastly, another factor to consider will be sticking to our rules no matter what. To recap all we have said, firstly, we look out for the time frame to trade. So you need to specialize yourself as a trader, not that you will be swing trading and scalping. You need to know if you will be specifically swing trading, specifically if you will be scalping, specifically if you will be day trading. Although you can do both, but as a beginner it is better to stick to one, and once you are proficient in one, then you can go ahead for an upgrade. The second is to choose the product you'll be trading. Not because some mentors or forex gurus are trading a product means you need to trade them. You need to have a personal relationship with any product you'll be trading. And the third is to be able to identify how your strategy performs to identify a trend or a ranging market. So you need to know that, okay, the market is trending, okay, the market is ranging, then I'll be able to apply my strategy. Then the fourth is defining your risk. Once you have your risk predetermined, then you are able to walk away from any trade. Either it's take profit or it's stop loss, you are always willing to walk away because you are working within a risk parameter you are willing to stomach. Then the fifth is the entries. Defining the entries, because the entries also determine the exit. The stop loss placement will determine the risk to reward. And the sixth is our exit, which is where you place your stop loss or your take profits. And the sixth, which is the most and the seventh, which is the most important, is sticking to the rules. So all these are very, very, very important. So write down these rules in developing your strategy, which is the time frame, number one. Secondly, the product. Thirdly, knowing how the strategy performs, either identifying a trend or a range. Thirdly, defining the risk. Fifth, entries, and sixth, exits. So now we are going to apply all this and backtest for 2 months to see how this strategy we are going to be designing here will work. So as the trader that I am, specifically, I am a candlestick pattern specialist, a chart pattern specialist, and a liquidity trader. So we are going to be working with those two to design our strategy. Firstly, to design this, we need to know the time frame we'll be using, which is the first step. So here, let us perceive ourselves as swing traders. We'll be sticking to the 4-hour chart. And secondly, which products are we going to be trading? We have so many products here, but we are going to be sticking to just 3 products. So we are going to stick to the USD CHF, the USD JPY. These two are majors, and the AUD JPY. This is an exotic pair. So thirdly, are we going to be focusing on a ranging or a trending market? The strategy we are going to be using is a very powerful strategy. So it works in both a ranging and a trending market. So now let us define our risk. We are going to be very aggressive, so we are going to be risking 2.5, or let us maintain a 2% risk. Don't let us be too aggressive. So our entries, for our entries, we are going to be using a 10 pip stop loss, a sniper entry stop loss for our trades, and our exits we are going to be targeting 1 to 10. So on each trade we are going to be targeting 100 pips. Either price gets to our take profits or price stops us out. So let us get to the chart to see how we are going to perform, and we are going to be sticking with this our strategy. So we are going to be backtesting last 2 months. Let's start from March on USD CHF. So the technical analysis we are going to be using are the engulfing pattern and the evening star. The engulfing pattern contains 2 candles. The first candle must be bullish, like this candle. It has to be bullish, and the second candle has to be bearish. So bullish, this is a sell candle. Sorry, bullish, this is a buy candle, and this is a sell candle. So the sell candle has to embody the whole of this buy candle, letting us know that there is a shift of momentum to the sellers. And in regards to time frame, we are not just sticking to the 4 hours, we are only going to be trading the London session. Let us recap. We are only going to be trading the London session. So all we need to do is to identify this pattern at the top of a trend. Here we can see a mini buy trend, then we can see a bullish candle. This is an evening star. An evening star comprises of 3 candles. You know that the engulfing contains just 2 candles, one bullish, one bearish, but the evening star contains 3 candles. One has to be bullish, the other one will be bearish, closing as a bearish candle, then the third one would embody the whole of the first one, also closing as a bearish candle, and it must not close above this second one. I hope we understand. So these are the 2 patterns we'll be trading, only the London session. To recap, we are only going to be trading the London session. So beginning of March, we have our first pattern right here, which is a loss. Wow, we are beginning with a loss. That is beautiful. So now we are in -2. We have another pattern here that happens during the London session, which is a loss. We have 2 losses. Wow, that is, we are in -4%. Then we have a pattern in March, an engulfing pattern that happens during that. The entry is during the London session, and we have an entry and it hits our take profit. Following all our rules, we can see when the pattern occurs, our entry during the London session, and we can see what happens. It drops successfully to our take profits. Wow, so we have 2 losses and 1 win. So far, the rest of April, no pattern yet. So we have 2 losses and 1 win. 2 times 4, 2 times 2, that is 4, and our win 1 to 10, 10 times 2, that is 20. So we have plus 16% on USD CHF, sticking to the rules we just developed right here. Now let us backtest on USD JPY from March to this month. Throughout the month of March, no opportunity for a sell. However, on this particular day, we have a pattern that formed, and we are going to be taking our entry during the London session. Let's go to the 1 hour. Once the pattern forms, yeah, on 1 hour, the pattern forms right here, and a retest during the London session and price drops. So on USD JPY we have just one trade, and fortunately it is a winning trade, which is 20%. Then on AUD JPY, throughout the month of March, if we backtest, no pattern at all. Then we have one occurring, a beautiful pattern during the London session, and we have a retest. Let us go. So I tried the best to simplify this strategy, not to complicate it too much, as there are other factors to look out, but to simplify it, just seeing how we developed a system right here. Then it's retest during the London session and it's 1 to 10. So here we have 20%. 20% on AUD JPY, 20% on USD JPY, and 16% on USD CHF. That is an easy 54% in 2 months, sticking to our rules, not letting the emotions get the best of us, and that is simply how to develop a winning trading strategy. You can develop it in any style you want, any form you want. As long as you stick to it, success is yours. Plan your trade, trade your plan, and most importantly, manage your risk and emotions.